Welcome to the first key workshop. I am Abby and I'm so excited that you all are here. This session is all about one thing, giving you the clarity and confidence to take your first step towards home ownership. And of course, we have Chris here again. We did the podcast with him last time and it was so popular, and everybody want to get more nuggets from you, Chris. So welcome.
Thanks, Abby. Thanks for having me again.
We have four first-time home buyers right now live in our session. It's Robert, Hiral, Gauri, and Akash. Welcome, everyone. So, in the next 60 minutes, we're going to walk you through the full journey from how you save for your down payment and how I give you the keys on the day of closing. So, over to you, Chris. Just walk us through.
Well, to get started, ideally, is just a matter of getting in contact with the right professionals. Someone like yourself, someone like myself. I always say, let's get a good lawyer in place, a good accountant in place, a home inspector, and we'll coordinate an appraiser if we need to, depending if you're putting 20% down or less. So if you're putting 20% down as a first-time home buyer, just to be clear, an appraisal is required. But if you're putting less than 20% down, the insurer, which will take care of the appraisal on the back end. Mind you, with less than 20% down, the amortization is reduced from 20 to 25 years versus a 20% down, the amortization is increased to 30-year amortization. So the difference between the two is the less the 25% down, the 20% down will not have an insurance premium. So the insurance premium does get added to the mortgage when you're putting less than 20% down. Okay, so it's a matter of understanding the differences between the two, and just getting started with an actual pre-approval. I'm just going to go over a few common mistakes, that people make when they're buying their first home. And one is really not getting it pre-approved before they start shopping. Everyone
Okay.
gets excited and says, "Oh, did a mortgage calculator and I see this is the type of property that I want to buy. Let's go put in an offer."
Correct.
Right. I just had a client that went in and bought a property. They wanted to rent it out, live in it, and also rent it out. So it's called owner occupied rental.
Mm-hmm.
Now, in order to do that, you have to have rents to support the income to help you buy that property. But the pre-approval is the most important piece. So why it takes more time to get pre-approved is you may qualify for a $700,000 property. But two things I will say. One is never over budget yourself, meaning that when we qualify you, you're only qualified based on your income, the down payment, the property taxes, and heat as an example. But your car payment, your insurance, your cell phone bill, your utilities, all these things are not calculated in your pre-approval. So I want all of you first-time home buyers to know that as a budget, understand what your monthly expenditure looks like, and then we can tell you, okay, maybe it's not 600, it's now 700 or vice versa.
Mm-hmm.
Okay, to get started in the market. The pre-approval process is actually very simple. The way we've designed it, there's a link that you can go to. It's an online application. There's no credit check that needs to be done at this point. It's just a matter of understanding where the client is at, where the buyer's at in the present moment, and how we can help them walk them through their journey. So patience is really the key here. It's not to jump in with 2 feet in terms of buying right away, because I've also seen in the past, in the last 2 weeks actually, somebody put in an offer with less than 20% down and went firm,
Wow.
which is a no-no. I will never advise anybody to go firm on putting less than 20% down because you don't know. The bank has to approve the deal, which is fine. But the insurer also has to improve the property as well. So if they don't like it, or they don't like the covenant of the client, or they may not like the way the income is and how the client's getting paid, they can decline the deal.
Right.
With less than 20% down, you're putting your hands in handcuffs. There's nowhere else you can go.
Correct.
Whereas if you do have the 20% down, we have multiple options. We can go to an A lender, we can go to a B lender, we can go to a C lender. We have ways to get you the money with the 20% down.
So, since we have a very I cannot, the people that we have right now in the room, they're very new to the real estate market. Can you just put some light on what is going for?
Yeah, perfect. So going firm means that you're putting in an offer on a property. You're going, let's say you go into multiple offers because that's most times when people will go firm. So if you have five people that are bidding on the same house, your offer with less than 20% down is not as strong as the other offer who is putting 20% down. So it's now up to the seller to determine which offer do they want to take. Do they want to take that first-time home buyer that's putting less than 20% down that needs to go through the financing process and still be able to get an approval before they can go firm? Or would they want someone like yourself that'll say, look, I'm putting 20% down. I can go firm. I have no problems. I don't need to get a home inspection. I'm confident with the appraised value. I know it's going to be supported. And the deposit that you give them, if it's $50,000 as an example, or $25,000 as a deposit, that deposit is now in jeopardy,
Right,
right? Because you're going firm with less than 20% down, not guaranteeing that you're going to get this mortgage.
right.
We will fine tune it as close as we can to ensure that you do get approved, but we don't see what the insurer sees or what the insurer is going to say.
Hmm.
So going firm means that you're bidding on the offer, you're going in with no conditions, meaning no financing conditions, no home inspection conditions, and you are agreeing to the purchase price of what you're buying this property for. So if you're buying it for $800,000 in hopes that the value is going to come in with the insurer, you could be jeopardized. So if it comes in at 780,000, well, now you're short 20,000. So
Right.
$20,000 now has to come out of your pocket. But if you've gone firm, you don't have the opportunity to be able to get that value ahead of time to determine if it's worth what you're buying it for.
Hmm.
So very important to not go firm so you don't lose your deposit, which is that 25K. Better
Right.
to what I always let real estate agents know and even buyers know is if you're planning to go firm, then let's make sure you do have that 20%.
Hmm.
And if as a contingency plan.
Right. So always go with the conditions.
Always go to the conditions, but what helps realtors that I kind of help because we're doing most of the legwork to ensure that the client is going to get approved 99.9% of the time.
Hmm.
But we want to make sure that the real estate agent also can help negotiate that offer instead of asking for a 5-day condition of financing to the seller.
Hmm.
Ask them for a 3-day condition just because that first time home buyers it's new to them. They want to make sure that they get the approval in their hand. They want to make sure that they can waive all the conditions that the bank is looking for. And then we sign back. So we don't need the full 5 days, but it's up to you, Abby, as the realtor to sell it to the seller and say, hey, like my client's the first time home buyer. We don't need the 5 days. We just need 3 days just from a formality standpoint. My
Absolutely.
mortgage guy has already told me that they're good to go. We just want to make sure they get the documents in their hand.
Correct. I mean, as a realtor, I always prefer going with condition, especially if the finance has been okay and good. I would really still want to go as an inspection condition because it is very important that we do our due diligence before we enter in the house and make it firm.
Absolutely. And excuse me, that's one of the common mistakes, right? Is people not doing the actual due diligence around the property, the type of property, the location of the property, and the inspection. Like, what if there's mold in the property and you don't even know,
Right.
right? Like, how much
Hmm.
is that going to cost to repair? And do you have that money to repair? So we always say keep 3 months of your monthly expenditure aside for
Right.
just in case.
Right. So you have also you explained three aspects of buying home for the first time home buyer in our podcast, and it was the credit score, the down payment, and the income. And would you like to shed some light quickly on these three aspects so we can open up the room for any questions?
Yeah, so the income, you need to make sure that you're in your job for not in your past probation within your first 3 months. But there's different types of income. There's an annual income, there's a salaried income, which just requires like a job letter and a pay stub.
Right.
Okay, so that satisfies that condition with all the lenders. And if you're looking at if you're an hourly employee, then you gotta have a file your taxes for the first 2 years, and then we can take an average of the income. Because see what happens with hourly employees is they get the opportunity to work more hours, right? Which increases their overall income at the end of the year. But they
Mhm.
also, when they take time off, if they're not getting paid, then their hours will decrease. So the banks also will give you a better idea to say, well, if the current year is higher than the previous year, then we can use an average of the 2 years of the income. If the current year is lower than the previous year, then we can only use the current year unless your job letter states that you work 40 hours a week, you're guaranteed the hours at $45 an hour, and then we can use that as the annual income. So there's different ways to slice the income for somebody that's hourly. And then there's the person that's business for self, which is most people in as a first-time home buyers, they're mostly on a full-time job, whether it be hourly or salary,
Right. Right.
right? So that's the income component. The credit is really important in today's market because Equifax is now uh, factors in the debt ratio based on your limits, not just
Right.
your balances. So if your limit is $10,000 and your balance on your credit card is always 8 to 10,000, then that's going to negatively affect your credit score. So the best way to do this is to just use up to 70% of the utilization, keeping 30% space as if you don't even have that line of credit or that credit card availability.
Right.
The down payment is also very important because that has to be as a first time home buyer, that especially your down payment has to be in the account for a minimum of 90 days.
Mhm.
Okay? Whether you're taking it from your tax-free savings account or your RSPs, it still needs to be there for 90 days.
Right.
Once it's in the account for 90 days, you also have to have a total of 1.5% of the purchase price
Mhm.
in savings on top of your down payment for the same duration.
Mhm.
So if you're putting 20% down, most lenders aren't going to ask for the closing costs because that's up to the client of what they're doing. They just need to satisfy the down payment component.
Right.
When you're going through the insurer, they want to make sure that you have this minimum of 1.5%.
Mhm.
Within that 1.5%, I'll just give you a quick idea of what's included. So you have your land transfer tax, which everyone has to pay, okay? There's land transfer tax, the registration of the mortgage, the title insurance, your legal fees. If there's any inspection fees, that's also buffered into that 1.5%. But
Mhm.
as a first-time home buyer, if your closing costs at 1.5% equates to $10,000, they're also getting a land transfer tax credit up to $4,000,
Okay.
right? So that also is being deducted from that 1.5%.
Mhm.
Still need to show the 1.5%, even though you're using less, is my point. Okay.
Yeah.
So those are the three basic components that you need to have to get started. And we do that just in our 30-minute intake call when I speak to the client. I make
Mhm.
sure that they have the right criteria before we take them to the applications
Okay.
page.
Okay, that's wonderful. We're going to share your Calendly link after the workshop as well.
No problem.
One question that is actually bothering me and what many first-time home buyers is like the interest is low now. There's lots of inventory, and still the first-time home buyers are scared to take the action. So, how would you, or what advice would you give to the first-time home buyers to take that action, or should they be taking an action right now, or should they be waiting?
I think it depends on the situation that they're in. And I think that's something within that 30-minute intake call we'll dissect even further to see where they're at. Because as a first-time home buyer, Abby, there's so much information that they need, right?
Mhm.
We're doing this as a high level within, the time frame that we're working with today, but there's so many intricate pieces that we customize to each individual.
Right.
So for a first-time home buyer, why they're afraid today to buy, most people are afraid because they don't know what they can actually qualify for, number one.
Mhm.
Number two is, are they in the position where they know their monthly expenditure, like I was saying earlier?
Mhm.
But if you think of it overall from the outside in, and you look at it from a 10-year or a 5-year journey, a 5-year plan,
Mhm.
if you're buying in today's market, the interest rates, the values, there's a lot of inventory, like
Mhm.
you mentioned. The interest rates are slightly higher. They are on its way down, but they are slightly higher than the norm.
Hmm.
But the values are also lower.
Right.
So you have a lot of opportunity with all these properties that are in the market. So I'm seeing a lot of first-time home buyers where they're looking for that condo, but when I remove the condo fees, let's say at 500 or $650 as on average of a condo fee,
Hmm.
like and just with condo fees, the older the property is, the higher the maintenance fee. The newer the building, the lower the maintenance fee, right? Because there's less work to be done on the property, on the building. But the maintenance fee, if we remove it, now we're seeing people upsize into like a townhouse
Hmm.
where there is no, so we're removing the maintenance fee,
Hmm.
increasing the purchase price to offset that maintenance fee, and now they can potentially get into a townhouse.
Right.
So when we narrow down the pre-approval for the client, we help them before they even come back to you, we help them understand the type of property they can buy, whether it be a condo or a townhouse.
Hmm.
And then we help narrow down the city that they can buy in based on property taxes and type of property. And
Hmm.
then it makes your job so much easier to help them along the way. Right. And then that now they're fully equipped because now they know what to expect and they know what you're going to look for when you take them out to look at properties. But in order to get around the fear is to really be able to understand the numbers,
Correct.
right? Once you know what your budget looks like and once you know what your monthly payment is going to be on the mortgage,
Hmm.
that'll help you determine the type of property. And it's just a starter home. This is not your forever home, right?
Right.
This is a home that people get into the market just so that way they can avoid renting. They can
Hmm.
have some sort of home ownership to get started.
Hmm.
And then we show them how to upsize
Okay.
in the event that they wanted to move out from that condo into the townhouse into the semi-detached, and the semi-detached into the detached home.
Correct.
There's a progression, and the only way you can get to that detached home is by starting and getting into the market.
Absolutely. And I would like to tell this to everybody here that me and Chris, we both are investor-driven people in this real estate market because we want every penny or if from your pocket should be making more and more money. There should be return on cash on every amount that's been invested in real estate. So, having said that, let's open up the room, and I would love to get questions for either me or Chris. Please feel free, and let's start.
I could start.
Sure.
Sure,
Yeah,
go ahead.
awesome. Yeah, so I mean, I just secured myself a job with the TTC. Um, this is the highest paying job I've ever had, and right now I'm renting an apartment in York Mills, right right beside York Mills Station. Beautiful place. I love it. My dream is to have a house there, in those beautiful houses, and potentially I would love to have different properties in different places, like different places of the world. I'd love to have places in the States. I'd love to maybe even explore my roots in Italy, right?
Yeah.
And this is a loaded question here, right? So this might not necessarily be like a, one conversation fixes all, but I'll leave that to you, the pros. I just want to know like where to start because I don't have a huge amount of savings, but my wife is working, I'm working, and I think we probably have maybe around 15 or $20,000 saved up between the two of us. And we have an action plan where I'm saving 10% every week when I get paid. Um, and our credit, I would say our credit isn't bad. Hers is probably like near perfect. Mine is maybe not as good as hers, but it's not terrible. So yeah, I don't know. I'm just curious where to start with this dream.
Well, let's start with the credit because this credit is going to get you to that overall goal in the end. The credit, and then of course the down payment, and then the income. But I'll start with the credit. As long as
Okay.
your credit score is minimal and you've got a minimum of two pieces of credit, then we know that okay, we can take you to any institution. We have access to all of the lenders.
What do you mean when you say two pieces of credit?
So you have whether it be a line of credit or a credit card or a combination of the two of each or a combination of the two. So the requirements are to have two pieces of credit for a minimum of 2 years. And the reason being is because then the bank can see that you're not to make a payment on one credit card is very easy, right? There's the responsibility around it is it's on the 15th of the month. You get paid on the 15th of the month and you pay your credit card on the 15th of the month. But when you have two pieces of credit and you have one payment that's due on the 15th and you have another one that's due on the 27th, well, now you're responsible to make that extra payment on the 27th as well on the second card, which a lot of people fail to do because
Right.
it's not in line or in time with the income with their paycheck that they're getting. So it's
Right.
important to have the two pieces of credit for a minimum of 2 years. Make sure you're paying your minimum payments. If you can pay it in full, a lot of people use credit cards for points, right? So if you want to use your credit card for points, you know, use it for your gas, your groceries and entertainment and all the things. You can use it, but you can't just go and pay back the credit card the next day. It's not going to do anything for your credit score, right? So you got to let it ride out for the 22 days, and then you can make the payment on the card. So that's the two pieces of credit piece, like why you have to have it. Now, the down payment you mentioned, you have about 15 to 20,000.
Yeah.
Right? So right off the hop, without even speaking to me or Abby or anyone, you know that the minimum requirement is 5% down on the first $500,000,
Right.
right? So you're 500, so that's 25,000. So right off the hop, you know minimum that you can buy for without knowing what you can qualify for, even on the income standpoint, even if it's higher, you know you only have 25K. So we got to come up with the closing costs for that 500,000, or we need to come up with 30 or $35,000 to get you to the 600 or the 650 range,
Right.
right?
Okay.
Because it's 500,000. We mentioned this on our YouTube on our video recording on the podcast, yeah, that you need 5% for the first 500,000 and then 10% on the difference. Okay, so if it's 600,000, then you need 35,000. If it's 700,000, you need 45,000
Right.
plus the closing costs. Okay, so that's your the down payment component. Now, your income is what's going to drive you to the value of the property. So the higher the income, the less of a down payment, which will increase your qualification in terms of how much you can buy for. But you're still restricted to the amount of money that you have as your down payment, right? So you may
Okay.
make $100,000 a year, but you only have the $25,000. So meaning that you can only buy up to 500K. But technically, if you had 50K with a $100,000 income, you're okay to go buy something for $800,000,
Interesting.
right?
So what about if for example, let's say because I have different side hustles, different things that I do, but it's not necessarily under a registered business. Do you think it would be wise to create a registered business and count that towards my income so that when it is time to apply for a house, that counts towards it?
Um, it depends on how much income that business is generating in revenue.
Okay.
So if it's if you're making like 100K on that business, then yeah, it's important for you to get to buy to get an incorporation and have a business license or business registration. But if it's cash jobs that you're getting and you can show that you're doing it on a weekly basis or on a monthly basis and you're getting an extra $5,000 coming in or $2,500, as long as you can show that progression of that cash income going into your account, then we can build a case to say, look, like he works full time, but he also has a cash job on the side, and here's how much his contributory income would be towards his overall income. So we would build a
Hmm.
case around something like that.
Interesting. So cash could even count towards it.
Depending on the nature of the business and how long you've been in it and things, yes, then yes.
Interesting. Okay.
Right? But that's something we would customize for you offline.
Okay, cool.
But in terms of getting to that dream homes that you're saying, that's really getting started, getting into the market. And everyone says, when's the best time to buy? And I'd say like the best time to buy is when you have the money to buy it, right? Because the interest rates are going to go up and down. It's a cycle, right? It's constantly going to change. So are property values. They're also going to go up and down. But when do you buy, knowing that if today the market is low and we have a lot of inventory, it's a buyer's market, you have a lot of opportunity, a lot of options to choose from. Why not try to see what you can get in today's market, knowing that interest rates are expected to come down, which will, have prices of homes increase in theory.
So
Right.
would that amount, for example, like let's say they're counting to 100K, they say, all right, my income's 100K. would it be mine and my wife's income together that would count towards the property?
Yeah, so it'd be a combined income, which is helps. That's what I was saying earlier. Like if you have the more income you have, the more you can qualify for. But then you need the down payment to support that minimum down payment requirement to get
Yes.
you into that bigger home, right?
So would it be like, do you think it's wise to get into something maybe smaller than what this dream? Because the house I was talking about in that area is like $5 million. Like that's definitely a longer term goal. But I'm curious if you think it'd be wise to jump into some other property that is sweet, the deal's good. Maybe it's not the dream home, but it's like the first step into it. Do you think that's a wise decision?
Yeah, absolutely. I always say like your first home is not the home that you live in forever. It's the home that you try to hold on to forever, using it as like as a piggy bank as an example. So if you
Okay,
can use your first home and hold on to it as and keep it as a rental property, you've now converted yourself from a home first time home buyer into a first time investor without even knowing.
interesting.
Right? So now you
Okay,
can become an investor and a homeowner, and you're growing your portfolio to get you to that $5 million property because the asset value that you're going to have along the way will appreciate in value. Now, some people have to sell that first home in order to take the equity from it to purchase the bigger property, and that's okay too. It all depends on the financial situation.
right.
We can hold on to the existing property and use the equity, which is the profit in that property without selling it and use it towards purchasing the next property, then we can hold on to both, right?
That's ideal.
And then ideally, and then you can grow your portfolio. But there's other variables that you got to take into consideration. Like, are you growing your family? Do you have kids? Are you looking for to be work by close to schools or highways, depending on where you work and how many jobs you have? Do you work from home? Right? All these variables factor into the type of property that you buy.
Interesting. It's a lot more complex than I gave thought to.
Yeah. So we do a deep dive and I'm just kind of using you as the scenario and thank you. It's a great input. It's a great questions that you're asking because it's a lot of people don't really go that far. They just want to know what can they buy today.
Right.
So we kind of map it out for them and say, well, here's like a GPS system that you could use. Here's where you start, and here's where you'll end up being. Because if you're buying a property now and the property appreciates by 5% every year for the next 5 years, and your principal on the mortgage, the pay down on the mortgage balance is reduced, everything in between is your profit. So we'll help you understand when you get to that sweet spot of what the profit is going to be before you make that next purchase, before you upsize. So now you have a plan to work on for the next 3 to 5 years. So when you come back to me at the end and you come back to Abby and say, look, I'm not buying the 5 million, but I'm going to buy the 1 million, you already have prepared yourself. We've already helped you prepare yourself along the way.
That's yeah, no, that's exciting. It's nice to the shift that I'm getting is it's more of a something that I can wrap my mind around and I can actually take action on, like a plan of a couple of years, opposed to sort of a loose, oh, I want this dream home, right? Like it sounds like there's, okay, I got to work on this. I got to make sure credit is good. I got to make sure that the income is at a certain amount, and it's nice to know that there's certain benchmarks and things that I can hit that will create open doors to the opportunities that I'm looking for.
Exactly. And I think the point around it is that you got to get in order for that to happen. So you could wait, right? You could wait 2 years from now and say, well, I'm going to buy, in 2 years, we're planning to save X amount of dollars. So that's fine, but you got to keep in mind that when you're buying in 2 years, interest rates may be lower, yes, but the property values might be higher. So
Right,
what we're seeing with a lot of first-time home buyers, and we're speaking to the parents of the first-time home buyers to say, look, our kids need the help now. If you're able to help them with getting into the market today, and would they need the extra, let's say $25,000 as additional funds for their down payment, someone like yourself that's going to be saving for the next 2 years this 25,000, if bank and mom and dad can help you when you need the help and give you the 25,000, you're still going to give them the 25,000 along the way in the event that, as time goes on, you have the time to save that money, but you also had the ability to get into the market as well.
right.
We kind of you kind of kill two birds with one stone.
That's so huge. That didn't even cross my mind too. That's another option.
Yeah, and a lot of parents are coming on as co-signers and guarantors with their kids,
Right.
which is awesome because 2 years ago it was like no, like we don't want to do that. It's a high risk. But now parents are understanding that they need to help their kids get into the market, otherwise they may not be able to get into it at all.
Yeah, it's
Yeah.
a crazy world out here right now.
Yeah.
Yeah.
So but the first home is really the home that you just want to get into, is my point. Once you get into the property, from there on out, you'll work on moving. Your mind will automatically take you to what am I going to do next? But we're telling you what you can do next right off the hop. So you just have to follow that plan. And then once you follow that plan, you'll get to that bigger home.
Mm, interesting. Thank you. I
So I
really
mean,
appreciate it.
everything that anywhere we go or anything we do, the number one thing people say is just get started,
Correct.
right? Because if we don't start, then there's no end.
I mean, the whole idea is to create passive income through real estate and, create financial freedom for everyone that we work with.
Yeah.
Yeah.
And there's going to be times like this that are going to happen again,
Hmm.
where interest rates are going to go up, property values are going to come down. There was a
Yeah.
pandemic, there's a economic roar in what's going on in our economy right now. It's going to happen. It's a cycle, the same way real estate's a cycle that goes up and down.
Yeah.
So
Yeah.
it's just where are you within that cycle, and what comfort level are you within that cycle along the way? First time home investors are a little bit on the sidelines in today's market. But investors, the ones that see the value in like the bigger properties, like the five plexes, for example, that are generating, that income, monthly income as positive cash flow, as an example, they're the ones that are seeing the value. But I'll say the investors have dropped by, say, 30%,
Right.
because
Right.
they already have a portfolio, they already have properties to work on. They need to make sure that they can cover their costs on a monthly basis. Prior to the interest rate increase, when the interest rates were low, people were positively cash flowing. Positively cash flowing means that you're making more, the income is covering more than your expenses.
Mhm.
Right. Absolutely. Yeah.
It-
I saw Gauri raising her hand. Do you
yeah.
want to ask a question?
Yeah, thanks, Abby. Sorry, previously my microphone was not functioning properly.
That's
So
okay.
apologies for that. Okay, so my question is, we are new to the country, right? So I heard Chris mentioning that a lot of these criteria have like 2 years of credit and some tax returns for 2 years, and you shouldn't be in probation period and stuff like that. So how would that? Because then, do I have to wait for 2 years before I go into the market and buy a house? Do I have to rent for 2 years? So yeah, that's my question.
A good question, Gray. So fortunately for people who are coming into the country, there is programs that are out there, and that's why it's important to talk to somebody like Abby or someone like myself to help you customize where you fit within the process. So if you've come here on a work visa or a student visa, as an example, and you've now got a job and you're in your job for a minimum of 3 months, and you've passed your probationary period, the lender and the insurer has a program that will allow you to use alternative pieces of credit, meaning that, and it could be for the 1 year, minimum 1 year. Okay, so if you are renting, I think I heard you say renting there, but let's say you're renting as an example, as long as you can get like a landlord's letter to say that you've been making your payments on time, then that could be replaced as one of the second credit components. Your cell phone bill to show that you've been making your payments on time, that also can replace your credit. But you always want to try and get the one credit card in the interim as well, this as a minimum, one credit card. And then the tenure around the credit card that you have will also help us build a case around the alternative pieces of credit. So it all depends on the scenario that you're in, based on if you're renting, if you're living with family, what type of credit do we use? But there are options to use with less than 2 years, to answer your question.
And how about tax returns? Because just started a job here, so I don't have any tax returns in the country.
Yeah, so the tax returns is more so like if are you salaried or hourly?
Salary.
Yeah, so for a salary, the tax returns aren't something that we would need at the moment. It would be more so to confirm that your income is satisfactory to the amount of money that you're looking to borrow. So if you have the income and you've passed your probationary period and you've been there, for a minimum of 1 year, then yes, we can use your income. Or even within that 8 to 12 months, if it's not completed in the year, we would have to build a case to say, here's where you're at, here's where you're going to be, and here's why we think you should get this approval. So there's options for someone like yourself, but just to make sure that, before you do anything of this sort, you do have your PR card, correct? Or you're in the process
Yeah,
of getting the PR card?
you have a PR. Yeah.
Yeah, okay. So as long as you've got the PR, then you're fine.
Thank you.
Anyone else? Hiro?
Hi, Chris. So the question I had was I have a wide array of questions, but I'll start with one, which is how long does the mortgage approval take? It could differ, but can you guide us through that?
Yeah, so there's a pre-approval and then there's an approval.
Hmm.
Okay, so the pre-approval we do with you, we sit down with you, we send you a link, and then you'll be able to apologies for that, guys. The pre-approval is what we do to tell you how much you can qualify for.
Yeah.
Once we know what you can qualify for, and then knowing all the materials that you need and the criteria, then
Hmm.
we can tell you, okay, X amount of dollars is what you can buy for, right? On that.
Okay. Okay.
Approval is when you actually sit down with Abby, and then Abby takes you through the process. Once I hand you back off to Abby and say, okay, Abby, here's approved for $800,000. Abby's going to start looking and start shopping and taking you out to look at properties within that price
Hmm.
range. Before you guys put in the offer, Abby will send me a copy of the MLS listing. I'll fine tune the pre-approval that we've done for you. And then you guys put in the offer. Once the offer gets accepted, then we get the final approval with the bank.
Hmm.
The turnaround time for us is usually 24 hours just because of the brokerage that our brokerage. We have those reports. So we get it very quickly in terms of turnaround time.
Okay.
Which is why I was saying to you, Abby, earlier that, instead of a 5-day condition, you can get a 3-day condition instead, right? Because we've already done the work, right? We already know what conditions are going to be required. We already have it on hand. Now we just have to prove it to the lender at that point. What else you got there for me on that one?
So, you discussed something with Robert where you said working from home and working from office can make a difference in terms of your mortgage or the approval process. So, I'm working hybrid right now, and people are calling everyone back into office again, right? So, how does that factor in? Is that an important part of the mortgage process? Most of us are first-time home buyers are people who have jobs that are salaried. So, how does that work from home, work for office quotient work?
Yeah, great. So I mean, from the pandemic part, a lot of people haven't really gone back to work. They're still now 3-day back to work. Some are 2-day
Mm.
back to work, but a lot of companies are also still have the work from home. So my point was that if you're working from home, the bank also we also look at it when we underwrite your file and when we look at you overall. I mean, if you're going to live in London and you have to work in Toronto, there's no way the bank's going to say yes, so you can go buy that property. It doesn't make sense.
Yeah.
So there, you have to factor in that commute time is what I was kind of more so referring to.
Okay.
But if you're working from home, like a lot of people, like my younger cousin, I mean, he moved out to London as the example, and he works from home. So we got confirmation from his employer to say yes, he does work full time and he does work remotely, meaning that he can live wherever he wants. He's not going into the office. So the distance wasn't a variable is why
Mm.
I was able to buy there.
Coming back to one more question I had, and again, it could differ from person to person. Which mortgage is better, fixed or variable?
Yeah, good question. So it's such a good one. It's so powerful, this one, and I won't spend too much time on it because but understanding the difference between a fixed and a variable rate. Okay, what's the pros and cons to each? But before we go there, in depending on the time that you're buying in the market, s sometimes the variable rate is lower than the fixed rate, and other times the fixed rate is lower than the variable rate. So there's times where we have no choice but to qualify you on that lower rate in order to buy that max purchase price that you're looking for, right? Because the lower the rate, the higher you can buy for. But if the rate is higher, there's no option to even get into the let's say the fixed rate is higher. You can't really go to a fixed rate at that point because you don't qualify with it. So you're kind of forced to go on to the variable rate to get to that price point. But if you have room within the price point, like let's say you qualify for 800 and you're only buying for 700, then you have the option between fixed and variable. And to help you get a better idea of what's better for you is, what's your appetite? Like what does your stomach
Mm.
tell you? Like do you just want to have a monthly payment that you know that is going to be fixed every month and it's never going to change and you don't have to worry about it? Or are you okay with knowing that the variable rate will go up and down in hopes that in the 5 years it'll be lower than average out to be lower than the fixed rate, right? The other advantage
Right.
to the variable rate is that if you, let's say you go on a 5 year variable, but
Mm.
within the next 3 years you get married or you have kids and the home that you're living in is no longer suitable for you. On a variable rate, you can break the mortgage with a 3 month interest penalty, right? And then you can go and purchase that next property. Whereas with a fixed rate, if you were to break the mortgage, the penalty is extremely high because it's the interest remaining on the balance of the mortgage for the remaining months. So you got to kind of have an idea of what your comfort level is in order to determine if you go fixed or variable. But on my end, unfortunately, if the whatever the lower rate is to get you to that max price is what we use, and then we work backwards in the event that you want to go on a fixed rate.
Okay.
That's
I
Good
have
cool.
one last question
question.
if
Oh,
no one else has, if the room's open. You said something about appetite, and with ChatGPT and Reels and everything circulating around, I saw something about a stress test. Is that still happening, and what is that in terms of
yeah.
mortgage?
So when you get pre-approved, even when we pre-approve you, so remember I was saying earlier, on a variable rate, if it's lower, then you can qualify for a higher dollar amount in the purchase price. But the stress test is included. So if the variable rate if prime is at 4.95, you have to add 2% on top of that. In the event that the rates go up by 2%, the bank knows that you're able to make the payments, right? So that's the stress test that's built in. Same thing with the fixed rates as well. It's the same idea. But if my point is if you're adding 2% on top of 5% versus 6%, your qualification will decrease, right? By that one within that 1% buffer there.
Right.
That's true. Thank you.
No problem.
So we have Akash here. Chris, Akash is a first-time home buyer waiting for a long time studying the market. He works with TD Bank,
Oh, okay, cool.
and I guess now he has a question.
Hi, Akash. I think he's on mute.
You have to unmute Akash. Can you hear us, Akash? Oh, unable to unmute. Okay, he's texting.
I just put through a request for you. Akash, you might. There you go. You got it. Perfect.
Okay.
Yeah, yeah. Hi, Chris. Thank you so much for your time.
You're
So I
welcome.
have two questions. First is if you are going for fixed, can you go then convert it into floating? Then if you are going for floating,
Oh, good
then can we
question.
go back to fixed? If yes, then there must be, of course, a charges from the bank end, I believe.
Yes.
So,
Very good question, Akash. So what happens is if you're going on a variable rate, you can lock into a fixed rate within that time frame, within your 5 year term. But if you're without a penalty is the point. But if you're going on a fixed rate and you want to revert to a variable rate, that's considered as breaking your mortgage, and there would be a penalty associated to it.
okay, and then maybe in that case we can just check if there is a lot of difference in the fixed and variable, we can pay the penalty and go for floating.
Yeah, but yes, you can. But in today, if you're going to do that, your better option is to go into a variable rate and then see, like, take an idea and wait 8 to 12 months and see what the fixed rates are doing. Look, the to help you better, the Bank of Canada is what decides on the variable rates. Okay? And that's the
Yeah.
announcement that comes out 8 times a year. But on the fixed rates, it's based on the Bank of Canada's like the bond yield. So if the bond yield of the Bank of Canada is doing well, then the rate will increase and decrease, right? Along
Yeah.
the way. They're not
Yeah.
really, those aren't really announced. So it's someone like myself or Abby that would kind of have to put you on an email, monthly email update to say, here's what the rates are, here's what they're looking like, they increase, decrease. And then you can lock into a fixed rate if you were to go into a variable when you first get the mortgage.
Yeah, yeah, got it.
Yeah.
And the second thing is at the initial stage of our conversation, like you mentioned, is if the down payment is less than 20%, you need to pay the insurance premium as well, like you need to consider. So, first question is it comes out to be like CMHC insurance? And if yes, or if no, that doesn't matter. How much premium it comes out to be? Like, the whole question depends on whether I should pay 20% down payment or whether it's okay for me to uh, pay the down payment less than 20%.
Okay, so you kind of have a loaded. So there's two things in there. So the first part is if you're putting down less than 20%, remember I was saying earlier is that your amortization is only on a 25 year, which means that your monthly payment will be a couple of $100 more than if you put in the 20%. Now, the insurance premium, the way it's calculated, is based on how much money you're putting down. So if you're putting 5% down, the insurance premium will be X. If you're putting 10% down, it's lower. If you put 15, it's lower as well. So it goes from 3.2 to 3 to 2.9 in around those areas. Don't quote me 100% on it, but it drops is my point. And that way you'll be able to determine because the insurance premium is rolled into the mortgage, right?
Yeah,
If you have the option to put less than 20% down and the 20%, then what we would do is work out the scenario for you to look at both sides. If you put less than 20% down, here's how much principal and interest you're going to be paying overall, inclusive of this insurance premium. If you put the 20% down, what's your savings look like without the insurance premium? What's your principal and interest payment on that? And what does it look like at the end of the 5 years?
all right.
Right?
Okay, got
So
it.
we'll help you narrow down that piece to make sure to help you make the right decision.
Yeah, got it, Chris. Yeah,
Yeah. But there's different ways you can also like if you're putting down 20%, if you say you have $100,000 at 20% is getting into a $500,000 property, right?
yeah,
But if we're putting $100,000 down on a million on $800,000 and you have the income to support it, that same $100,000 puts you into an insured mortgage, which is less than 20%, which is a 25-year amortization. So it can still work, but you can increase your purchase price, right?
yeah,
With the same 100K. So if you tell me what that number is when we sit down, then I'll tell you both options as to with the 20 and without the 20.
yeah, got it. Okay, got it. Thank you so much, Chris.
Yeah, no problem.
Any other question, guys? I think we are good and so much of great information, Chris. And every time we sit, we there is always something new coming, and there's so much clarity that has been brought by you
Thank
for
you.
these all these first-time home buyers. I wish they get to their dream home as soon as possible. So I would like to tell you one thing that we both strive to create an investment strategy or a proper real estate strategy for all of the people that we work with. And for that reason, we will be sharing our Calendly link. It's a free 30-minute consultation with me or Chris, where you can go deep into your situation and we can guide you and we will work with you if we are a right fit.
Yeah.
I say this because uh, we cannot promise that we can do everything for everyone. We only work only and only if we are a right fit because we want to do the best for your situation, your dream, and your house. And saying that, I would really like to thank you, Chris, once again. And we look forward to come again for these kind of events and guide the first-time home buyers and, of course, the investors. We have many investors waiting for you and get the consultations, and I will bring them on board soon. And thank you to all the participants, Robert, Hira, Gauri, and Akash, for all your questions. And that brought so much clarity for you and for everyone who is watching. So keep an eye on the replay in your emails. And also, we will be posting this on our social media with a link to book an appointment with me or Chris for a free 30-minute consultation. Thank you.